Okay, so you want to own an insect farm. You want to buy a warehouse, set up thousands of plastic trays, dump in some food scraps, and watch millions of black soldier fly larvae passively multiply while you collect check after check from animal feed buyers. It sounds like the ultimate low-cost, high-margin, futuristic green money printer. But behind that eco-friendly fantasy is a massive industrial reality. Because globally, the commercial insect farming market is projected to surge past $2 billion annually by 2026. That is $2 billion generated not by selling artisanal bugs to restaurants, but by converting industrial waste into animal feed, pet food, and fertilizer. To put that in perspective, that is roughly equivalent to the entire annual global market for fresh cranberries, generated almost entirely by an industry that barely existed a decade ago. And yet, despite all those billions flowing in, nearly half of all newly funded insect farming startups struggle to reach commercial profitability in their first 3 years. The giant headline revenue numbers make it look like free money, but the actual operating margin is trapped in a brutal battle against electricity costs, climate management, and biological risk. Understand the precise physics of keeping billions of insects breathing, eating, and breeding at peak efficiency, and you understand this business. Miss it, and you will go bankrupt owning one of the most technologically advanced, high-demand agricultural facilities in the world. To understand why this industry is exploding right now in 2026, you have to look at the massive structural crisis in traditional agriculture. Global livestock, poultry, and aquaculture industries require millions of tons of protein to feed their animals every single day. Historically, that protein has come from two sources: soy, meal, and wild-caught fish meal. But soy production requires vast amounts of arable land and water, while wild fish stocks are heavily overfished and strictly regulated. The price of traditional fish meal has routinely hovered near historical highs over the last few years, forcing commercial feed producers to hunt for sustainable alternatives. The real customer of a commercial insect farm is not an adventurous human-eating bug-based snacks. The real customer is a multinational aquafeed manufacturer, a commercial poultry feed mill, or a premium pet food brand. They do not care about the novelty of insects. They care about protein density, digestibility, and price per ton. Insects, specifically the black soldier fly, offer an incredible biological cheat code. Black soldier fly larvae can consume almost any organic waste, grow to 4,000 times their body weight in just under 2 weeks, and yield a dried meal that is roughly 40 to 50% pure protein. Demand is not just durable. It is backed by corporate net zero commitments and tightening environmental regulations that are forcing feed producers to lower their carbon footprints. But not all insect farms are the same business. Before you buy a single tray, you need to understand the three distinct business models operating in this space today. The first model is the integrated automated mega facility. These are massive, 50,000 to 100,000 square foot centralized factories built with tens of millions of dollars in venture capital or institutional debt. They use robotic cranes, automated climate zones, and internal waste processing facilities. They run at massive scale, generating gross margins of 40 to 50%. But their initial debt load and capital expenditure are so astronomical that net margins often hover in the thin 8 to 12% range for the first decade. The second model is the regional decentralized processor. In this model, you build a 10,000 to 25,000 square foot facility focused entirely on taking local food waste from nearby food manufacturers, breweries, or regional farms and processing it on site. Gross margins here are slightly lower, usually around 30 to 35%, because you lack total robotic automation. However, your net margins can actually be healthier, often 15 to 22%, because your initial capital debt is vastly smaller, and your input feedstock costs are frequently zero or even negative, meaning companies pay you a tipping fee to haul their waste away. The third model is the specialty nursery and breeder. Instead of growing larvae all the way to harvest for feed mills, you specialize exclusively in the delicate biological cycle, breeding adult flies, harvesting their eggs, and selling young, 5-day-old neonates to other grow-out farms. This is a high-tech, lab-heavy business model. Gross margins can exceed 60% because you are selling high-value biological genetics rather than low-value bulk protein. However, the risk profile is extreme. If your climate fails or a disease wipes out your breeding colony, your revenue drops to zero overnight. Regardless of which model you choose, the core operational logic of a grow-out insect farm is remarkably simple. You acquire organic waste. You feed it to larvae in vertically stacked trays. You harvest the larvae after 12 to 14 days. You separate the live insects from their waste. Then, you dry the insects into protein meal and press them for oil, while drying the remaining waste into fertilizer. In this operational chain, there is ON number that dictates whether you make money or go broke. The feed conversion ratio on a dry matter basis, combined with your yield per cubic meter of facility space. In traditional farming, you measure yield per acre of land. In insect farming, land is irrelevant. You measure yield per cubic foot of climate-controlled air. Let's walk through the actual math to see how this works in practice. Suppose you operate a mid-sized facility that produces 1,000 metric tons of dried insect protein per year. To get 1,000 tons of dried meal, you need roughly 3,300 tons of live, wet larvae, because insects are about 67% water. Black soldier fly larvae typically operate at a dry matter feed conversion ratio of roughly 1.8 to 2.0. That means to produce those 3,300 tons of wet larvae, you need to feed them approximately 6,000 tons of wet organic waste substrate. Now, look at how the revenue and cost levers interact with fixed costs. Dried insect meal currently trades on the commercial market for around $1,800 to $2,200 per metric ton, depending on protein content and certifications. Insect oil, squeezed out during processing, sells for another $1,200 per ton. The waste product left behind, called frass, is an exceptional organic fertilizer that sells for $150 to $250 per ton. If your facility sells 1,000 tons of protein meal at $2,000 a ton, that is $2 million in primary revenue. You also extract 300 tons of insect oil at $1,200 a ton, adding $360,000. Finally, you generate 1,500 tons of dried frass fertilizer at $200 a ton, bringing in another $300,000. Your total gross revenue sits at $2,660,000. If your facility is optimized, your variable costs, feedstock transport, young larvae, packaging, and fuel, might run around $1 million. Your fixed overhead, facility lease, labor, debt service on your drying equipment, and baseline HVAC electricity might sit at $1,200,000. That leaves you with $460,000 in net operational profit, a very healthy 17% net margin. Now, watch what happens if your operational efficiency drops just a tiny bit. Suppose your climate control fluctuates by a few degrees, causing the larvae to metabolize their food slower. Your dry matter feed conversion ratio degrades from 1.8 to 2.4. Suddenly, you need 20% more feedstock and 3 extra days of rearing time to reach the same harvest weight. Because your rearing cycle is 3 days longer, your facility can perform fewer harvest rotations per year. Your annual output drops from 1,000 tons down to 800 tons. Your gross revenue drops from $2,660,000 to $2,128,000. But because your facility is running 24/7, your fixed HVAC electricity, facility lease, labor, and equipment debt remain virtually identical at $1,200,000. Your variable costs only decline slightly. Suddenly, your $460,000 profit is completely wiped out, transforming your facility into a $50,000 annual net loss. In insect farming, because your climate and facility infrastructure carry heavy fixed energy costs, every single percentage point of biological efficiency flows straight to the bottom line, or drags you into the red. So what does it actually take to get into this business in 2026? You cannot simply rent a standard industrial warehouse, turn on a couple of fans, and call it a day. First, site selection and zoning are major hurdles. Most municipalities do not have a zoning code explicitly titled insect agriculture. You will often find yourself caught in a bureaucratic nightmare between industrial manufacturing zoning and agricultural zoning. Industrial zones allow processing and heavy mechanical drying equipment, but they may prohibit housing live agricultural biologicals. Agricultural zones allow live animal rearing, but they often prohibit the heavy industrial processing equipment needed to dry and press the protein meal. Securing a conditional use permit can take anywhere from 6 to 18 months and cost tens of thousands of dollars in legal and environmental consulting fees. Second, environmental permitting and odor control are where first-timers get completely blindsided. Millions of insects eating thousands of tons of decomposing organic waste generate significant heat, moisture, and intense ammonia vapors. If your facility vents untreated air into the surrounding neighborhood, local code enforcement will shut you down within days following resident complaints. You are required to install industrial biofilters, air scrubbers, and high-capacity HVAC systems capable of turning over the air in the rearing rooms multiple times per hour while scrubbing out volatile organic compounds. Let's break down a realistic startup budget for a modest, regional 15,000 square foot grow-out facility designed to process roughly 15 tons of wet waste per day. For facility acquisition and retrofitting, expect to pay around $250,000 to build out insulated, cleanable, panelized rearing rooms with specialized epoxy flooring and drainage systems that can handle daily high-pressure washdowns. Your HVAC, climate automation, and environmental air scrubbing infrastructure will be one of your largest single upfront costs, easily requiring $350,000 to $450,000. You need precise control to keep rearing rooms at 82 to 88 degrees Fahrenheit and 60 to 70% relative humidity, 365 days a year, regardless of the weather outside. For operational equipment, including 10,000 heavy-duty nestable plastic rearing crates, automated crate stackers, substrate mixing equipment, and mechanical separation screens. Budget roughly $300,000. For post-harvest processing equipment, including a commercial microwave or disc dryer to dehydrate the larvae and an oil press to extract lipids, you will spend another $400,000 to $550,000. Add in $100,000 for utility connections, water hookups, and high-voltage power upgrades to the building, plus $50,000 for initial permits, legal fees, and biosecurity setup. Finally, you must carry at least $300,000 in working capital to cover electricity, initial labor, and feedstock freight before your first harvest is processed, tested, certified, and paid for by a corporate buyer. All in, starting a functional, semi-automated regional insect farm in 2026 requires a realistic capital outlay of $1.7 million to $2.2 million. So the question that should be sitting in the back of your mind is, what does the revenue reality look like once the operations are actually up and running? If you look at the titans of this industry, companies like Protix in Europe or InnovaFeed, they operate facilities spanning hundreds of thousands of square feet, backed by hundreds of millions of dollars in corporate backing and venture capital. They sign massive, multi-year supply contracts directly with global animal nutrition giants like Cargill or Skretting. They achieve economies of scale that allow them to push production costs down below $1,200 per ton of dried meal. As an independent operator running a $2 million regional facility, you are not competing directly with those mega corporations on raw bulk pricing. Your target revenue range for a 15,000 square foot plant operating at high capacity sits between $1.8 million and $2.5 million annually. Reaching full operating capacity typically takes 12 to 18 months as you fine-tune your biological breeding cycles, stabilize your feedstock supply chains, and pass lab testing for heavy metals and pathogens to satisfy commercial feed buyers. The risk factors in this business are unique and unforgiving. The first is biological collapse. In a traditional farm, if one pig gets sick, you quarantine it. In an insect facility with 300 million larvae stacked vertically under one roof, an outbreak of a bacterial infection or a viral pathogen can wipe out your entire inventory in 48 hours. Biosecurity protocols, air filtration, strict worker sanitation, and feed sterilization are not optional luxuries. They are life or death operating procedures. The second risk factor is feedstock contamination and volatility. While black soldier flies can eat almost anything, commercial feed safety laws strictly govern what you can feed to insects destined for the animal food chain. In many jurisdictions, feeding municipal post-consumer table scrap waste or animal manure to feed-grade insects is strictly illegal. You are often restricted to pre-consumer agricultural byproducts, such as spent brewer's grain, potato peels, or bakery waste. Securing long-term, consistent, clean feedstock contracts at a low or negative cost is one of the hardest operational hurdles in the entire business. The third risk factor is energy price sensitivity. Because your facility acts as a giant climate-controlled incubator, your electricity bills will be enormous. If energy prices spike in your region, your baseline operating cost shifts immediately, threatening your profit margins if your long-term protein sales contracts are locked in at fixed prices. So, what is the final verdict? Should you actually build a commercial insect farm? This business is absolutely not suited for the casual investor looking for passive income. Nor is it suited for a traditional real estate developer who thinks they can simply buy equipment and hire low-cost managers to run it. It requires a rare crossover of skills: industrial engineering, commercial waste logistics, biological discipline, and long-term business-to-business sales strategy. It is best suited for an experienced operations-focused entrepreneur, a team with a strong background in food processing or industrial automation, or an existing agricultural business looking to vertically integrate its waste streams into a high-margin secondary product line. If you have the capital to absorb a 2-year ramp-up, the engineering discipline to master climate mechanics, and the strategic foresight to secure both waste inputs and corporate feed buyers before turning on the machines, commercial insect farming offers one of the most compelling, defensible, and high-growth industrial margins in modern agriculture. Master the precise biological physics of vertical climate management, and you can build a highly profitable, sustainable enterprise that literally turns waste into gold. Ignore the operational realities, and you will quickly find out how fast a multi-million-dollar investment can rot from the inside out.